Hey everyone, my name is Alex Morgan, and today we're diving into one of the most important and misunderstood developments in the silver market right now: why silver is flowing out of New York vaults, and why buyers in Asia are willing to pay significantly more for the same metal. This isn't just about price differences, it's about global supply flows, inventory dynamics, futures market structure, physical premiums, currency positioning, and the broader shift in demand between Western paper markets and Eastern physical markets. If you want clear, data-driven analysis without hype, the kind that connects vault reports, futures spreads, and macro trends into one coherent picture, make sure you're subscribed. Because what's happening beneath the surface in silver could shape the next major move. Let's start with the core data point: registered silver inventories in New York. The primary exchange for U.S. silver futures is the COMEX, which operates under the CME Group. COMEX vault data separates silver into eligible and registered categories. Eligible silver meets exchange specifications but is not currently designated for delivery. Registered silver is available for delivery against futures contracts. Over the past several months, registered inventories have declined significantly from earlier highs. While total combined inventory remains substantial, the registered portion, the immediately deliverable supply, has been trending lower. At the same time, open interest in silver futures has remained elevated relative to registered stock. That ratio is important because it measures how much paper exposure exists relative to deliverable metal. Now here's where it gets interesting. While inventories in New York have been drawing down, premiums in Asia, particularly in Shanghai, have risen above Western spot prices. The Shanghai Futures Exchange and physical market quotes in Shanghai have shown silver trading at a premium relative to COMEX spot equivalents. In certain sessions, that premium has been several dollars per ounce higher. Why does that matter? Because when price differentials exceed transportation, insurance, and financing costs, arbitrage becomes attractive. Traders can buy silver in New York, ship it to Asia, and capture the spread. That creates a natural flow of metal from lower-priced markets to higher-priced ones. This is not unusual in commodity markets. It's how global price equilibrium works. But what makes this moment significant is the scale and persistence of the premium. When Asian buyers consistently pay more, it suggests stronger physical demand relative to available supply in that region. Let's break down the drivers behind this demand. First, industrial demand in Asia remains structurally strong. Silver is critical in electronics, photovoltaics, semiconductors, and high-efficiency electrical components. China remains the world's largest manufacturer of solar panels. Silver paste used in photovoltaic cells represents a major industrial use. Even with ongoing efforts to reduce silver intensity per panel, overall installation growth keeps aggregate demand elevated. Second, investor demand in Asia behaves differently from Western ETF-driven demand. In the West, investors often gain exposure through ETFs and futures. In Asia, there is traditionally stronger appetite for physical bars and direct exchange delivery. When price dips occur, physical buying often increases, especially if local currency dynamics support it. Third, currency effects matter. If the US dollar strengthens while local Asian currencies stabilize or appreciate relative to domestic purchasing power, imported commodities can become more attractive. Conversely, if investors expect dollar weakness ahead due to shifting U.S. monetary policy, holding physical silver can act as a hedge. Now let's connect this to vault flows in New York. When registered inventories decline, it does not automatically mean a shortage. It can simply mean metal is being reclassified, transferred to eligible, or exported. But if exports coincide with sustained foreign premiums, that suggests arbitrage-driven physical movement rather than accounting shifts. Recent warehouse reports show steady outflows relative to inflows over several months. Even if total inventory remains historically sufficient, the trend matters more than the absolute number. Markets price change, not static levels. At the same time, futures positioning has shifted. Data from the Commodity Futures Trading Commission shows that managed money net long positions in silver have fluctuated significantly. In periods where price rallied strongly without a corresponding surge in speculative long positions, it suggests underlying physical demand played a meaningful role. That's an important distinction. If price rises purely on speculative leverage, rallies can unwind quickly. If price rises alongside physical tightness and inventory drawdowns, it suggests structural support. Now let's discuss spreads. The difference between futures months, such as March versus May contracts, can indicate stress or comfort in near-term supply. When near-dated contracts trade at a premium to longer-dated ones, that condition is known as backwardation. It signals stronger immediate demand relative to future expectations. When markets are in contango, with future contracts more expensive, it implies comfortable supply. Silver has periodically moved toward tight spreads when physical demand intensifies. If Asian premiums remain elevated and registered inventories continue trending lower, near-term spreads could tighten further. What could happen next? There are several possible scenarios. If Asian premiums persist and arbitrage flows continue, New York inventories could decline further until spreads narrow. At some point, either Western prices rise to close the gap or Asian premiums compress. The adjustment mechanism depends on relative demand strength. If U.S. monetary policy shifts toward easing and the dollar weakens, Western investment demand could accelerate again. In that scenario, silver prices on COMEX could rise, reducing the east-west spread and stabilizing vault flows. If global growth slows significantly and industrial demand contracts, Asian premiums could fade. In that case, exports from New York might slow or reverse. There is also a geopolitical dimension. In periods of rising geopolitical uncertainty, Asian buyers often increase physical precious metal purchases. Silver, being more affordable per ounce than gold, can see retail and industrial accumulation increase during such periods. Let's zoom out to the broader structural context. Global silver supply growth has been relatively constrained. Much silver production is a byproduct of base metal mining. That means supply growth depends heavily on copper, lead, and zinc production levels. If base metal mining slows due to economic contraction, silver supply can tighten unintentionally. At the same time, long-term demand from green energy remains robust. The global push toward electrification, renewable power generation, and semiconductor expansion keeps silver in structural demand. Now combine that with vault drawdowns in New York and premiums in Asia. It suggests that while the paper price might look stable within a certain range, say high 70s, the physical market underneath is more dynamic. This brings us to the critical price question. If physical flows continue eastward and registered inventories approach lower operational thresholds, the paper market may eventually need to reprice higher to discourage exports. Higher prices in New York would narrow the arbitrage spread. Conversely, if silver fails to hold key support levels and investment demand weakens, vault outflows could stabilize without dramatic repricing. Technically, silver has been oscillating within defined support and resistance zones. Traders are watching breakout levels above prior highs as confirmation of momentum continuation. If Asian demand remains firm and Western speculative positioning remains light, the upside path could open quickly once resistance breaks. On the downside, if macro headwinds, such as rising real yields or strong dollar conditions, intensify, silver could retrace toward lower support before reattempting higher levels. One of the most important metrics to monitor going forward is the gold-to-silver ratio. If silver outperforms gold, that ratio declines. Strong physical demand in Asia could catalyze that shift. Another key variable is ETF flows. Western silver ETFs hold substantial physical inventory. If Western investors begin adding exposure again while Asian demand remains firm, the combined effect could accelerate upward price pressure. But it's important to remain balanced. Markets are adaptive. If premiums widen excessively, supply routes adjust. If New York prices rise sharply, arbitrage disappears. If Asian demand slows seasonally, premiums compress. What we are witnessing is not necessarily a crisis, but a rebalancing of global silver flows. The West dominates price discovery through futures. The East dominates physical consumption. When those two diverge, metal moves. So where might silver head next? If current trends persist, sustained Asian premiums, steady New York drawdowns, moderate Western positioning, and stable industrial demand, silver could gradually push higher toward the low to mid $80 range over the coming months. If macro liquidity expands and real yields decline, upside acceleration could extend further. If economic contraction reduces industrial consumption, prices could consolidate or retrace before resuming structural uptrend. The key takeaway is this: silver flowing out of New York toward Asia is not random. It is a rational response to price differentials and demand imbalances. But sustained flow changes can influence price structure over time. The market ultimately balances through price. If Asia keeps paying more, either Western prices rise or Eastern premiums fall. Right now, the adjustment process is still unfolding. Keep watching vault reports, exchange spreads, ETF flows, currency trends, and industrial demand data. These are the real indicators beneath the headline price. Because when physical and paper markets diverge for too long, something eventually gives, and when it does, the move can be fast. I am Alex Morgan. Stay analytical, stay disciplined, and stay ahead of the data.